Attila, thank you for coming back onto the program. It's been probably one of the most turbulent months for iron ore in the last year or two, I'd say. Can you, to start off with, talk us through what's happened? Obviously, last month we were talking about iron ore prices falling off a cliff a bit because of the CCP output reduction. We've seen a whole spiral of events around Evergrande come into play with things changing on a daily basis. What's the current update? Can you talk us through what's happened over the last couple of weeks and really what's going on at the moment?
Sure, yeah. I mean, it was really, over the last, I guess, a week or two ago, it was really an extension of the steel production curbs that we all know about. The Chinese Ministry of Environment and Ecology, I think if that's the correct name for that particular department, came out and said that actually there will be heavier cuts from now until the end of March 2022, specifically centered around the end of the Beijing Olympics, Winter Olympics. So that has really driven further declines in iron ore as the market sort of faces this risk-off sentiment regarding lower steel output and relatively lower iron ore consumption. So that's been driving the extent of the decline a couple of weeks back. Then you've had individual provinces struggling with some power restrictions and cuts on restrictions of using electricity and so on, and that's obviously been driven primarily by how high coal prices, which have been making it pretty difficult for heavy industry to operate. And specifically, we're talking steel, we're talking alloy, copper, and so on. So that really sort of added more fuel to the fire. And then in the last week, you've had the news around Evergrande come to the fore and really sort of drive prices even lower than the market had anticipated. So, the low point we hit is about $93 a ton on SGX's October contract. So since then, the People's Bank of China have announced a sort of cash injection, liquidity into the banking system to protect against any imminent default of the many billions of RMB that they've announced. So that obviously has provided a floor to the markets and set the tone as well that actually China wasn't willing yet to let a company of that size fail. So we go back to that old argument of, are they too big to fail? And obviously the answer is yes, they are too big to fail, given the potential societal discord that could eventuate if they were to let a company of that size go bankrupt. So since that time, we've hit that low of $93 a ton, and now we're currently sitting at about $112 a ton. So there's been quite a substantial recovery. I think it's more of a relief rally. The market completely ignored data on Thursday, which showed that weekly rebar production had fallen by 12% week on week, which was just phenomenal. I guess that's how oversold iron ore was, to completely, not even bat an eyelid at that kind of data. What concerns me is that what's going to happen next is well, we're still, I don't think, at the end of these steel production cuts, so we could see some more heavy cuts coming in the next week or two. So while we have this relief rally back up above $100 again, it might not last for long.
Right. My next question was going to ask you around, obviously, if Evergrande are bowed out, whether or not the iron ore price will go back up to where we saw it last month. It sounds like that isn't the case either way. Still, production caps obviously are going to keep that lower by the sounds of it. Moving forward, in terms of what your outlook is for next year, I saw UBS release a report where they're predicting around the $89 per ton, 62% Fe content for iron ore. Does that sound about right? Have you forecasted for next year? I know you do short and medium term, so it would be good to sort of get your outlook on that.
Yeah, I mean, that level for the quarter coming, we wouldn't disagree with. Typically Q4 is quite a weak period. You have pretty negative steel consumption quarter on quarter and year on year. for Q4 this year. And obviously, you just typically in terms of seasonality, that's cold weather impacts steel consumption, and therefore the mills respond accordingly. Obviously, this year we're going to have relatively lower output anyway, given the government mandated cuts. But we should still probably see that seasonality appear in lower consumption and lower outputs, but it will be heavily muffled by the mandated cuts. Now, looking forward to next year, and obviously Q1 is going to be hit in terms of steel production as well. So it's the output will remain low during the Winter Olympics to ensure blue skies and good air quality, and because China will be on an international stage, and specifically the capital will be on an international stage. For the rest of the year, $89 to me seems a little bit on the bearish side. So we still haven't completed, or still haven't seen the full effects of the huge amounts of stimulus that have been released to tackle COVID. We'd sort of be looking sort of anywhere between the $90 and $110 range. That's not massively far away from UBS, but I think that's a fairly comfortable range where it should be sitting. And yeah, I mean, the Q2 is typically a strong quarter for steel consumption in China. So I think once Beijing sort of exits from center stage after the Olympics, you may sort of see these mandated production curbs sort of eased, or even potentially removed.
Oh, okay. So are you thinking that obviously with the Olympics coming up, it's just it's a play to reduce pollution in the build up to that? Is that the idea? And then
absolutely, because I mean it's going to be televised all over the world, and you can just look at social media and people are posting pictures of blue skies and so on, and it obviously puts China in a good light, and obviously more importantly the environmental impact, which is the most important part of it all. I guess most of the analysts in resources, natural resources, and heavy industry, are always quite skeptical about China's policies and rhetorics, and whether it's going to last, and whether they'll stay the course. So far it had been looking like they would stick true to their agenda, but then you do get events like Evergrande where they go back to the old playbook, and but then again you can't criticize, because US, UK, Europe have done the same things in the past with their banking industries. So we can't pick on any one nation.
No, of course. One of the other areas I wanted to touch on actually is obviously if we are going to see China remove these caps next year potentially, if investors are looking at iron ore at the moment or over the next quarter, when you think it may even reduce further, is that a potential good buying opportunity for investors? Or are we looking at next year, if these caps are removed, that we could go up way over $100 per ton again, maybe touching towards 150, 200 again?
I think that was not a one-off, but that was a particularly freak occurrence. I don't think that's it's not going to be part of the course. We don't see much upside above sort of 120, 130 for next year. Obviously, we have more short-term view, so
yeah.
we look at advising on trading the intraday and the intra-week and so on. So that means there's always money to be made. It is possible. I mean, if you're looking at a sort of quarter-on-quarter or year-on-year view, then it's probably going to remain relatively, I guess, steady by comparison to the year that's just occurred. It's I guess you can always look at potentially selling the rallies and buying the dips is the generic trading terms, and looking for opportunities when it's oversold or overbought. That's what we typically do and typically advise on. So there are always opportunities. One thing I guess I would sort of guard against, the upside risks, I guess, for iron ore at the moment. One is, as you mentioned, as we've mentioned as well, is the easing of production curbs. That's one. Secondly, the longer the price stays below $130, $120 a ton, you're going to start seeing supply response from the small cap miners, and you've already started seeing it in drips and drabs in the press. There's one mine in Australia that's idle production because it's dipped so far below its cost of production, and obviously there were a plethora of mines coming back on stream over the last sort of 6 to 9 months because at $235 a ton, everyone's making money, everyone's owning yachts and Ferraris, but once you dip below sort of 145, 130, then a lot of companies start looking like they're in trouble, and so it's better to sort of idle production and wait for the price to recover. But the question is, do we recover back to a sustainable level for them to be able to operate? So you may start seeing more headlines in the press about these smaller cap miners sort of shelving operations for the time being. So those are the two major potential upside risks. But you've got to do the math and see how China's steel production curbs, if maintained, then that's not going to really make a difference whether these small caps are out of the market or not.
Okay, well, thank you so much for your time, Attila. It's always an interesting time with iron ore at the moment, and hopefully we'll have a catch up next month to discuss and see what's happened again.